Good evening, friends, and a warm welcome to this webinar. So today's webinar is on the ongoing NFO of Mirae Asset Banking and Financial Services Fund. And to run us through, the details about this fund and why one should look, at making an investment in this fund, we have got Harshad Borawake, Head of Research, Gaurav Kochar, Research Analyst from Mirae Asset Investment Manages India Private Limited. So without wasting further time, I'll hand it over to Harshad. Harshad, you can take it over from here.
Sure. Thank you. Good afternoon, good evening, everyone. Thanks for joining this call. So as the title suggests, BFSI sector is a lifeline for the economy as well as like individual like you and me. So I think this is one sector which clearly touches lives for in many forms, and we'll speak more about in detail soon. So for the sake of simplicity, so what we'll do over the next 25-30 minutes, we have divided this presentation into three parts. So the part one is more about giving the overview of the sector as well as the investment universe, which will also talk about importance of the BFSI sector in the economy, and we'll speak about various trends in the subgroups, which include banks, NBFCs, insurance, mutual funds, and capital market players. Second part is more about the investment framework and how we are going to go about constructing as well as managing the portfolio. And lastly, part three, why BFSI now? I think that is the most pertinent question. So where we'll cover valuation and our investment arguments. And at the end, we also given one slide which gives a color on our current preferences. When we are going to try to build the portfolio. Yeah.
Thanks, Harshad. Good evening, everyone, and thanks for joining on this call. So we'll begin with the BFSI space. So as you all know, banking and financial service sector, it's not just about banks. So traditionally, while one might look at it, 2 decades ago, it was all about banks. But over the last couple of decades, the other attributes, which is the capital market, NBFCs, insurance, a lot of them have gained traction, and as a result, their composition in the overall pie has also increased. So just to give a background, it's not just about banks. There's whole host of financial services within the BFSI space. Coming to how the banking and financial service sector relates to the lives and the economy. So clearly, when the economy does well, the financial income increases. When the financial income increases, we either do a high ticket spend or probably save and invest the money. So in either of the choices we make, we may go for a high ticket spending in the form of a home loan or a car loan, or invest in bank deposits, invest in an insurance product, or invest in an EMC, or maybe directly invest in equities. All of this again comes under the umbrella of BFSI. So this is the broader horizon of what BFSI sector entails. Coming to how BFSI, how we as individuals touch the BFSI sector on a day-to-day basis. So take a small example. For example, you're paying an online utility bill, maybe through a wallet, or maybe through UPI, maybe through net banking. In either of it, I mean, you will be coming in contact with the BFSI sector. You purchase groceries, you swipe your credit card to pay the bill. Again, the credit card is a financial service product. You may apply for an insurance, go for a mediclaim, take a home loan, invest in an SIP, in a mutual fund. All of this, which we do in our day-to-day life, touches one or the other aspect of BFSI sector. So this is just to give a sense of how we as individuals come in contact with the BFSI sector on a day-to-day basis. Coming to how the BFSI sector is linked to the economy, as we can see in the chart here, the orange bars are nothing but the GDP, and as we see the GDP, when the GDP grows, the orange line and the black line, which is the broader markets, Nifty 100 and Nifty 200, they seem to do well. But if you look at the brown line, which is the banking index, and the blue line, which is on top, the financial services index, they tend to outperform the broader markets when the economy does well. So this is the historical evidence of last 15-16 years, where we've seen the financial services clearly outperform all the broader markets and benchmarks when the GDP grows. So this we believe will continue to happen over the coming years as well. When we talk about GDP, one of the important parameters while calculating GDP through the consumption route is savings. Thankfully, in India, we all are very much savings focused. If I look at the savings rate, it's almost 19%, one of the highest in the world versus average of 9%. And if I look at historical, household savings, maybe a couple of decades back, large part of it went to physical assets. It could be in the form of real estate, it could be in the form of gold. But what we've seen over the last decade or so, a lot of these household savings have moved into financial assets. It could be in the form of deposits, mutual fund investments, direct investment in equities, buying an insurance product. So the overall theme of financialization of savings has kind of kicked off in the last decade or so. And we believe that this is a significant step, and we believe that the financialization of household savings has just begun, and there's a lot more to it. Maybe in the coming decades, this could grow even bigger. The another important aspect of GDP is the credit. If I look at the credit penetration, which is credit to GDP, it has remained broadly stable between 58 and 60%, 56, 57 over the last many years. Usually, if I take a 20-year cycle, we have seen credit growth having a multiplier effect of GDP. So if the GDP grows by X%, the credit growth simply grows by 1.3x. So this kind of multiplier effect has not happened over the last few years, but we believe that with the credit trends improving, maybe a couple of years down the line, the private capex, which has been broadly absent for the last 5-6 years, will kick off, and that would probably lead to some sort of credit growth improvement, and the credit penetration as a result would increase. Also, if I compare the credit to GDP of various other peer nations, someone like a China, someone like a Brazil, or Mexico, all of them are north of 100%. For China, it is more than 200%, the credit to GDP ratio. So despite credit growth in the last many years that we've seen, it's still underpenetrated, and there's a lot of potential to improve further from here on. Now, moving on to the sub-segments within the BFSI, the first one being the largest and probably the most important is banking. Before I get into specific of banking and what are we looking at as in terms of trends, recent trends, I would just give a brief of how banking model functions and how they make money. So banks typically take money from depositors and borrowings from other banks, other institutions, and deploy that money and lend it to customers or invest in some other papers. So the spread that they earn between the borrowing cost and the lending rates is the income for the bank, broadly speaking. Along with that, they also make some fee income on cross-selling certain products. So this is the broad the revenue stream for banks. But despite this, the sensitivity to earnings is maximum when it comes to provision. So even if the bank has seen steady growth in incomes, the earnings could be very low if the credit cost or the provisions, as we say, is higher. So what determines what could be the provision is nothing but the asset quality of the bank. Now coming to the current theme in banking, wherein a lot of concern has been raised by various investors as with regards to the asset quality. One of the key metrics that we track is the gross NPA, and as we can see on the right hand side chart, the gross NPA trends after FY16 worsened. At 2018 it peaked, and since the last couple of years it has been coming down. So post FY16, when the RBI conducted an asset quality review, a lot of the corporate accounts were recognized as NPA by banks, and this continued for a period of 2 years till FY18. And after that, a lot of the resolutions happened. Banks wrote off a lot of corporate accounts from their books, which resulted in significant improvement in asset quality over the last couple of years. So with this, we believe that and also the fact that banks are making continuous provisions on their existing NPLs, we believe the large part of the corporate NPA cycle is behind us, and incrementally we believe this ratio could moderate even further. Coming to another important aspect, which is the capital position of banks, we look at the tier 1 ratios, which is the core capital of a bank. Here, if I look at the tier 1 position in FY20, it's at 13% for the system as a whole, which is highest over the last 8 years. This is primarily because a lot of private banks raised money in the last 12 to 18 months, and also government had recapitalized the PSU banks over the last 12 to 18 months, which resulted in capital ratios improving. So and this ratio would have further gone up after last 6 months when a lot of the companies had raised capital. So the point we're trying to make here is that the asset quality is improving and the capital position of banks is fairly strong. Another important theme that has been running is the digitization. We believe that over the last 5 years, the digitization has improved. With the UPI, a lot of other credit card, debit card related spends, other payment platforms of banks, mobile banking, internet banking, a lot of the fintechs coming into the game, the wallet players contributing significantly in the distribution. All of this has resulted in some sort of digitization story in the BFSI space. But having said that, if I look at the left-hand side chart, it seems that India is still fairly underpenetrated in terms of number of non-cash transactions per capita. It's one of the lowest. If I compare South Africa, Brazil, which are similar economies, they are at much higher level. So there's still a lot of improvement, as far as digitization story is concerned. And unlike China, where large part of the digitization is taken care of by the large payment players, the large wallet players, in India, the digitization story revolves around banks. And even in the next decade or so, we believe that Indian banks would be the one driving this overall theme of digitization. Moving to another important part of the BFSI vertical, which is NBFC. They form roughly 20% of overall credit in the economy, and roughly it was around 12% maybe 10-12 years back. So their share in the overall credit pie is consistently improving. They serve the underbanked and the unbanked, especially in the rural and semi-urban areas. The three products that probably they compete neck and neck with banks are auto financing, housing loans, and gold loans. These are the three products where the market share has been increasing, and they've been competing neck and neck with banks. Systematically, they're fairly important, given that they've been increasing in size and stature. So they remain a key part of the BFSI vertical. Moving on to mutual fund, growth. The growth in AUM is at 4x over the last 10 years. Still highly underpenetrated, as the mutual fund AUM to GDP is fairly low at 12%. If I look at the other capital market metrics, which is number of demat accounts, the trading volumes in BSE and NSE, all of them indicate that there has been some sort of improvement in penetration, but still it's far from normal or far from what it could be in a decade or so. We see significant potential in capital markets going ahead. Life insurance, another underpenetrated theme. Here, if I look at life insurance premium to GDP, it's one of the lowest at 2.7. And if I remove, the ULIP portion of premium, which is nothing but an investment product more than an insurance product, the numbers look even more lower. So the protection gap, which is on the right-hand side, is probably one of the highest in India versus other comparable peers. We believe that next leg of growth in insurance would come from the protection business, which is more profitable. Coming to the general insurance, the non-life part, here we believe that health insurance could be the next big product to drive the next leg of growth. What we have seen, just to give an anecdotal evidence, post SARS outbreak in 2003, the health insurance industry in Korea and Hong Kong, which was growing in low single digits between 1999 and 2003, suddenly grew at high teens during 2004 and 2007. So this is the kind of jump we saw in health insurance industry premiums, and we expect since COVID outbreak has happened, a similar story to pan out in India, where penetration would increase multifolds, and a lot of the people who are not opting for health insurance would start doing so. And if the initial trends are to be seen over the last 6 months, the health insurance premium, especially on the retail side, is growing in high double digits, which is again a positive sign. And we believe that over the next 2 to 3 years at least, this growth momentum could sustain. This is the summary of whatever we've been talking about, the under-penetration theme, and India versus the other comparable nations in each of the parameters, credit to GDP, mortgage penetration, life insurance, and mutual fund, and see how under-penetrated India is vis-a-vis the peers. Coming to this slide on push by the government and regulators to improve the financial inclusion. Just one good example is the Jan Dhan Yojana, which was announced in 2014-15, and in 5 years, the penetration of the total accounts covered by adult population roughly 80% of adult population now is covered by a bank, covered with bank account. So this is the kind of penetration level that we have reached with this Jan Dhan Yojana. Along with that, there's been a push in other segments. So crop insurance is one where a lot of push has come from the government, and there's been a push from Rashtriya Swasth Bima Yojana (RSBY) policies of the government on the health insurance side. There's been a lot of focus, on the unified payment interface, which has led to digitization. Coming to microfinance, here it used to be a 25,000 crore industry a decade or two back, and now it's at 2.5 trillion industry. So financial inclusion in real terms has reached the bottom of the pyramid to a great level. So all these steps are in the positive direction. We don't know how big this can become eventually. I think only time will tell. But these are certainly positive steps towards the drive of financial inclusion, financialization of savings, and could be biggest contributors in the coming years.
Sure. This slides basically shows the contribution of financial sector within, let's say, Nifty 100 or Nifty 200 names. I think it's interesting to note that if you go back a decade or two back, let's say in 2002, so at that point in time, technology or IT companies were large part of the index. 2007-8, partly it was oil and gas, again driven by one company. Then there was the infra boom for some years. For the last 6-7 years, consistently, if you can see, the weight of the BFSI as a sector, which includes bank as well as non-banks, that has increased by almost 8 to 9%. Within that, if you see NBFCs or non-banks, that again has improved by almost 50%. Going forward, if we were to look at next decade, one is obviously the trend in terms of BFSI sector growth. So as Gaurav had mentioned earlier, typically a BFSI as a sector grows roughly around 1.3 times the nominal GDP growth. We see, we don't see any reason why that trend should not continue going forward. And the other thing is, a lot of new companies got listed over the last few years, more so on the insurance space, some on the capital markets. Going forward, let's say 12-18 months down the line, even LIC would get listed. So in terms of diversification, the sector, as Gaurav had mentioned, is not only about banks. It has a lot of many subsectors. Within NBFCs also, you have various plays which would include housing finance companies, vehicle finance, gold finance, consumer finance. So to that extent, as a fund manager, we would have a lot of option in terms of investing. In the sense, each sub-segment will have a different cycle, and clearly, depending our preference or where we think the companies within the cycle, we will have options how to go about investing in the same. Coming to fund, as a SID or as per the mandate, 80% of the fund would be invested in the BFSI names. But for all practical purposes, I think we'll invest almost 97-98% within the BFSI. If I have to go more in depth in terms of how we'll go about managing the fund, so clearly one is the fund would be market cap agnostic, in the sense we can invest across the market caps, unlike let's say if you look at any other diversified fund. So while they would have a weight of to BFSI anywhere between, let's say, 25 to 30%, but their exposure to the sector would be primarily driven by the large names. But in the BFSI, I think that would not be the case. We would have option to pick up early growth companies. Obviously, like the way we look at the way we manage our funds, it will be largely bottom-up approach when we try to build the portfolio. In terms of stocks, roughly, I think we would have around 18 to 20 names within the fund. But as a safe harbor, we are saying that we could have around 15 to 30 stocks in the fund. Now, coming to process, again, I will draw parallel here. So, basic research process, or the way we go about investigating or analyzing the stocks, as well as building the portfolio, they would be similar to how we manage our other funds. But the differentiating factor would be given that this is a sector specific fund, so there'll be BFSI related filters which would be applied out here. Yeah, Gaurav, you want to take through those, please?
Sure, Harshad. So the investment process can be categorized into 5 steps. The first step is identifying the universe, which is in our case, as Harshad earlier mentioned, the BFSI. So banks, NBFCs, insurance, CMCs, capital market, all of it form part of the BFSI universe. The second step would be to apply some qualitative filters on the companies. So the qualitative filters can be in the form of ascertaining management quality. This can be through the leadership. This can be through strategic vision, through corporate governance practices. These are the broad qualitative filters that we'll apply to assess the management quality. We do a thorough scan of the portfolio. It could be in the form of interaction with industry experts. It could be in the form of interaction with the field agents, the recovery agents, the collection agents. We do on a sample basis. We do some field visits, branch visits to check on the portfolio quality, the underwriting process, which undergoes the overall lending business. Similarly, I mean, we also do a scan on the franchise strength. This could be by doing more and more product differentiation analysis. What is the competitive positioning of the company, etc. So these are the qualitative filters that we typically apply on a company or a product to assess whether they qualify or not. After applying the qualitative filter, we come to the third step, which is applying quantitative filters. These are more tangible in nature. These are typical ratios that we look at. It could be the long-term growth that the company has done, the return ratios, the efficiency, the cost efficiencies, or it could be in terms of banks and NBFCs, the asset quality, the gross NPA, the credit cost, etc. So here we do more visible sort of screening, apply some quantitative checks, also on a relative scale if they operate in the same industry with peers. So after all of this is done, we do a thorough scan of valuation, which is the fourth step. So here, for every company, we have a residual income-based modeling at a certain cost of equity. We do keep some margin of safety in our estimates, and once the value is finalized, we also do a relative valuation, which is comparing the valuation of a similar company of a company in a similar business or a similar vertical. So yeah, after doing both, the absolute as well as relative valuation, if the price is comfortable, then we go ahead and do the fifth step, which is portfolio construction. Here we look at the basic benchmark weights, the liquidity parameters, the other risk parameters from market perspective before adding the companies into the portfolio. So these are the 5 broad steps that goes in the investment process. Along with that, just to mention, we would like to keep a balance between the high growth companies, the compounders as we call it, and also some sort of value picks which can be re-rating stories in the long run. So that's the mix that we look at. Roughly 65 to 70% of the portfolio would remain the core. That's the idea, and roughly 25 to 30% of the portfolio could be used as tactical calls, based on price actions in certain companies. So yeah, these are the broad highlights of our investment process and the strategy as alignment. Coming to market outlook, here as we've seen in one of the earlier charts also, over the last decade or so, the Nifty Bank and the Nifty Financial Services Index has clearly outperformed the broader markets. This is just a highlight of that. If I look at valuations, currently on the left-hand side, we can see the private banks valuations are at 1 standard deviation below the long-term average, closer to that. And if I look at the pre-COVID valuation, which is November, December 19, that time it was trading at closer to 1 standard deviation above the long-term average. So, because of COVID outbreak, the valuations corrected significantly. There has been some sort of sharp pullback, but still it's trading at a fairly attractive valuation. The reason why we saw violent reaction on the downside was because of some concerns around the asset quality. So here in this slide, we've just summarized what's our view on the post-COVID asset quality scenario. Just to give a backdrop, the RBI had extended a 6-month moratorium to all borrowers There was a fiscal push from the government side wherein they gave a 20 trillion package. One of the key aspect of that was the 3 trillion MSME credit guarantee, which most of the lenders have utilized effectively to help the borrowers come out of stress. As things stand, 95 to 97% is the collection efficiency reported by all the large banks. And if I look at NBFCs, roughly 90 to 92% is the collection efficiency which they've reported in the month of September and October. So asset quality as things stand seem reasonably fine. Most of the companies are saying that the restructuring number could be as low as 2 to 3% of overall book, which come July, the fears were that this number could be in double digits in some cases. So I mean the fear seems to be moderating, and the fiscal push, the help from the RBI on moratorium front, the MSME credit guarantee scheme, and a lot of liquidity measures taken by the RBI has certainly helped sector manage their liquidity, manage their stress in an effective manner. And what we see, 95-97% collection efficiency is an outcome of that. Along with that, if I look at the bank balance sheets, the PCR stands at around 70%. If I look at the extra provisioning, banks and NBFCs are carrying anywhere between 1 to 2.5% of loans as additional provision cover, which means they could take care of anywhere between 2 to 5% of stress with the existing buffer. So net, what we are seeing is the asset quality is improving. It's certainly not as bad as what it was feared after the first quarter. The bank has made prudent provisions. The companies are making additional provisions also, and we believe that this could all result in normalization of earnings that could drive the next leg of re-rating in the sector. Coming to the macro steps taken by the regulator on the liquidity front, I think over the last decade or so, the CRR and SLR rates have been coming down. This is again to boost liquidity in the system and to create more and more credit. It's at a decadal low. Similar is the case with policy rates. They have been coming down sharply over the last 18 months. And what we see is the theme of low cost of capital, running quite well, resulting in some sort of additional liquidity buffers for both banks as well as NBFCs. So, as I spoke earlier, the outcome of this could be that the earnings will normalize. The core operating profit growth will normalize in FY22. We expect the return ratios of banks to return to normal in FY22 and 23 largely, which means that the overall earnings normalization theme, which was there pre-COVID, is only delayed by a year or 18 months. It's not derailed as such. So yeah, this sort of normalization could trigger a re-rating from here towards the 1 standard deviation above which we saw at the pre-COVID level.
Yeah, I think coming to why BFSI now. So one, just to summarize what Gaurav has been saying up till now. So clearly there is under penetration across the non-banking side. As we look towards the next decade, clearly the sector should grow ahead of nominal GDP growth. But again, just to give a perspective, let's say a year back, when we are looking in at other funds, we had already turned overweight on the BFSI as a space. To give a backdrop, let's say in FY16, RBI under Raghuram Rajan had asked bank to do the asset quality review, and once post that, all the banks had to recognize the NPAs more so on the corporate book side. And once you recognize the NPAs, obviously you have to do the provisioning. So sitting in FY19, our thought process was, let's say FY21 would be the first year of normalized earnings. But then obviously COVID happened, and now the normalization of earnings has slightly delayed. Our thought process is that, as Gaurav said, it's not derailed, but it's more delayed. So it's a 1.5 year delay in terms of earnings getting normalized. Already we are 9 months through that. So if you remember earlier in March, April, at that point in time, there was a lot of concerns in terms of how the NPA number would pan out. The moratorium numbers are also trending quite high. But now, post the 2 quarter results, post the commentary, also looking at various data points, the confidence level has increased. The confidence that the eventual NPA numbers would be much lower than what market is factoring in. So to that extent, obviously there is some run-up which has already happened, in the stocks. But we would say, nevertheless, even if you look at the valuation now, so versus banks, trading at one standard deviation above the long-term averages prior to COVID. So now, as we speak, banks are still available, or sector is still available at one standard deviation below the long-term averages. So to that extent, I think in the next 12 months, you have a trigger of earnings normalization. 12 to 18 months down the line, you would have a trigger of private capex coming back, which would lead to further compounding, and the sector remaining at a current valuation. I think it's a largely sweet spot, according to us. Yeah, Gaurav, you want to take in more depth to this?
Yeah, sure. So why BFSI now? Probably the most pertinent question, and we entail our key investment arguments in five broad points. The first point being its close link with the economy. So as we discussed in the earlier slides, it remains one of the key contributors to GDP. It may be in the form of consumption. It may be in the form of financialization of savings as a theme. It can be in the form of private capex, as Harshad alluded to, which might come in the coming years. So it's if government estimates are true and India are to become a $5 trillion economy in the coming years, BFSI remains the growth engine to deliver that kind of growth in the economy. So yeah, it's a close link to the economy. It's a play on the India growth story. That's the first argument. The second argument is the significant growth in the private market share, be it in banks where we've seen the private players gaining market share in both the deposit as well as credit. The private players have been gaining market share in insurance, in life insurance and non-life insurance from the incumbents and the PSU players. So why exactly is this happening? It's because of capital constraints. One, it's because of integration issues that private banks and some of the private players are facing. Number two, and third has been the lack of focus in entrenching a strong distribution and product differentiation. So if I look at the private, the product mix is far more superior in terms of profitability. Whereas PSU, they are abided by some sort of government policies that run. So they're forced to do some sort of products which are not that profitable. So these are the various reasons why the growth has been taken away from the PSU players by the private players in the last few years. And we believe that given that the large part of these issues are still not resolved, there could be more market share gained by the private players from the PSU players. The third point we are making is the improvement in NPA cycle. So as we mentioned earlier, the NPA seems to be coming off. If I look at a lot of the resolutions at NCLT are happening, and we are seeing some sort of recoveries in large accounts. Incremental stress doesn't seem very large. It looks manageable from whatever the management has been commenting. If I look at the provision levels, they're comfortable at 70 to 80% for most banks. So net we believe that the large part of the corporate NPA cycle is behind us, and on the incremental front, we don't see much NPA coming in. So all of this could relate to an improved NPA cycle for the medium to longer term. Coming to the fourth point that we make is the strength of the balance sheet. Be it in case of banks and NBFCs, the share of low-cost liabilities seems to be increasing on banks. If I look at the liability mix of NBFCs, more and more longer-term liabilities are being issued. So the ALM mismatch, which was the biggest fear in NBFC, is down to an extent, given the large share of bank loans, large share of market borrowing, and not CPs, which are short duration. Another important point is the capital positioning, which we saw that it has hit a 8-year high, and Tier 1 ratio of banks is at around 13%. If I look at the liquidity buffers, NBFCs are carrying extra liquidity between 10 to 15% of AUM, which in a normal case would have been just 5% of the AUM. So the balance sheets is getting stronger, and even if there is some sort of pain from asset quality, we believe that the balance sheet is much stronger to take that or to absorb that pain. So that's the fourth point. And coming to last but not the least is valuation. Valuation, as Harshad also mentioned, one standard deviation below the long-term average it's fairly attractive. If I look at risk reward, it's certainly more favorable to invest even at these levels from a longer-term perspective. So these are the 5 broad points why we think one should invest in BFSI sector now.
Yeah, so This is just summary of the what we currently in the space. So clearly, private bank are the preferred picks. One of the reason is they are obviously well managed. Over the decades, we have seen private banks gaining market share first on the asset side, and of late the market share gains have also started on the deposit and more so on the low cost deposit side. Asset quality wise, they have demonstrated strong underwriting. I would say barring one or two names. Again, I think one of the important factor for the private names, or I would say for a banking sector as a whole, is that if you look at the technology as a change driver, so technology has disrupted lot many other sectors, but I think banking or BFSI is one of those few where it has used technology in its favor. So in the sense, not only it is using technology to do more analytics to increase the business, but also in terms of underwriting or monitoring the portfolio, they have used technology quite efficiently. The digitization trend, again part of the technology change, has been used to drive the business efficiencies as well as do the business growth. Balance sheet wise, again private banks have been smart enough to they always typically do raise the capital ahead of the times, and also in terms of provisioning they have been quite prudent. The other important factor, if you look at last 5 years, let's say globally or more so in China, so we have seen emergence of payment players, and what has happened there is the incumbent banks were not able to take advantage of it. New players came in, but I think that's not the case in India. So incumbents or the banks have taken a lead in this either on their own or through a partnership. So to that extent, this new business opportunity, the incumbents itself are able to capture it, and this I think coupled with the valuation which we think is in a sweet spot now, clearly this segment remains our preferred pick. Second piece which we like is insurance. So here again it's a high growth sector. Within that I would say protection as a share is increasing. Why it is important? Because it is more profitable as well as granular. As Gaurav was saying, it's hugely underpenetrated. It has a long runway for growth, and as the growth happens, as it scales up, the profitability would also increase as the efficiencies kick in. Valuation wise, again I would say as we speak now, they are at reasonable valuations given the growth which they are expected to report. Third bucket which we like is NBFCs and capital markets both. So first on the NBFCs, again NBFCs we cannot paint all the NBFCs with the same brush. In the sense, one obviously, as it has various sub segments, and every sub segment would have a different cycle. But what is common across the NBFCs, and more so after the IL&FS crisis, what we have seen, the NBFCs with better parentage, the NBFCs which have shown good underwriting. So those NBFCs are able to get liabilities at competitive prices, and obviously which also means that in difficult times at the cost of others they can also gain the market share. So as a fund manager, we would have a lot of options when to pick and choose either at what point in time, whether we like housing finance or let's say vehicle finance, gold finance, or any other sub segment within that. But we do know that NBFCs as a place, they are very cyclical place. So similar to other funds here also will be quite cautious. So valuation will have a paramount importance when picking any NBFCs. Coming to capital markets as a play, which includes mutual funds, brokers, or to that matter, I would say rating agencies or also wealth managers. So there maybe one or two names could make up to the portfolio. Again, here what is important is underlying management competence or acumen, and also valuation is also very important. The last bucket is the PSU bank. So here one obviously PSU banks are always, I would say, capital starved. That's what we have seen. From the valuation point of view, they have been always attractive, but I think from the capital point of view, they always need capital. And the issue with the capital infusion, as and when the government does the capital infusion, is that given that many of the large part of PSU names trade at less than one price to book. The day they raise the capital or the day capital is infused, it's a ROE dilutive or dilutive, which is not the case for the private banks. So private banks, which typically trade at more than one price to book, so as and when they raise the capital, it is value accretive on day one. So within PSU, I think the way things stand now, I think only one name could make to the portfolio. Again, in there you have a lot of good profitable subsidiaries, which are at par in terms of their profitability or service levels, even at par with any other private names. Yeah, so this is largely the summary, I think, what we wanted to say. Yeah, we can take questions now.
Sure. Thank you, Harshad. Thank you, Gaurav. This was a wonderful presentation that you have run us through, and I'm sure all our participants would have got insights about this fund. The entire process of selecting the stocks, and how this fund can generate wealth for them over a period of time. So, participants, we are open for Q&A session. So on the app on the top, we have a question mark sign. You need to just click on it and you can post your questions. So we do have a few questions that have already popped up. So let me just run through the first one. So this question is from Mahadevan KS. The question is, considering the current pending decision from Supreme Court on moratorium, how the NPAs in the financial sector is going to be viewed once an unfavorable decision is given?
Yeah, I'll take that, Harshad. So on moratorium, the case in court right now is to waive off the interest on interest, and I believe that the government has already passed passed a mandate for all the private banks and public banks, and probably some of the banks have also implemented it. I think barring some foreign banks, all of them have implemented this interest on interest waiver. So the matter now is whether the lift on NPA recognition, whether that would happen or not. And but if I look at banks when they reported the 2Q numbers, they also gave a pro forma NPA when if I exclude the Supreme Court order of standstilling an account. So if I include that as NPA, I think that's still at manageable levels. Going ahead, what we are seeing is the companies when they talk about the restructuring, which is the potential stress that could turn into NPA going ahead. That number is anywhere between 2 to 3% of overall loans. So that number is still not large. If I look at the macro indicators, lot of it is normalizing. If I look at electricity consumption, GST collection, e-way bill generation, toll collections, all of them seem to be suggesting a normalized scenario. So we believe that with this, and coupled with some sort of normalization in the economy, the NP level should not rise beyond whatever is being highlighted by the management.
Yeah, thank you, Gaurav. So the next question is from Himanshu Chawla. I'm sure you might have come across this question a lot of time. Why are the valuations of PSU banks so low?
So it's a combination of basically two things. So for any bank, so for that matter, bank as a business, while it's a very simple business in the sense you raise liabilities either through deposits or borrowing, and then you lend it to the borrowers. What is important is the asset quality, to the what kind of borrowers you lend it to. So here what has happened historically, more so on the PSU names. So it's a combination of I would say underwriting, while on the book the underwriting looks quite strong, but when it actually comes to disbursement or following the norms, so there historically we have seen that lot of PSU banks typically tend to have lot of NPS over the cycle. Over the years, what has happened that given that government is the promoter, so they kept on bailing out or infusing the capital, and things have been going forward as usual. But from the investor point of view, or for you and me, when we try to invest whether in a company or any bank, So what is important is that one is obviously they should have a return on equity at least more than our cost of capital, which in the Indian context is, while interest rates have turned lower, but nevertheless, what we want is at least, I would say, 11 to 12%, at least, that kind of return on equity. So in those, I would say quantitative parameters. So qualitative, I think we already spoken about, but on the quantitative parameters, PSU banks really doesn't, doesn't really tick mark all the boxes. So to that extent, I would say investors, whether you or me or even FIS, so they would slightly, be very cautious in investing any of the PSU names. Again, I think second on the operation front, private banks have shown a lot of competence in terms of capturing the market share, and the trend is visible over the last few decades and last few years. What has happened is that the deposit side, where PSU banks were quite sticky, but there also now private banks have made made quite good inroads. Even that which was the forte of PSU banks, so that is again now taken up by the private banks. So net combination of lot many things. It's not that they don't have value, but the point is, if I look from the outlook point of view, a lot of things need to change within the PSU banks for them to trade at higher valuations.
Thank you, Harshad. So we'll be picking up the last question, and this is from Arun Menon. The question is, what is your take in the recent RBI's declaration in favor of large corporate houses to set up full-scale banks, whether it is, whether it will be a positive or a negative impact on banking sector as a whole?
Gaurav, take that.
Yeah, sure, I'll take that. So right now, what we have got is the working committee report, the working group committee's report. We need to see whether this gets implemented. If I look at past in the past, RBI has not really given corporate the license to run banks. So if I look at large corporates like L&T were not given the banking license earlier. Same is the case with other couple of corporates who had then applied. So history suggests that RBI, although the working committee has recommended, RBI will be very cautious, especially given the failure of some of the large banks and the operations in some of the cooperative banks which has been happening. I believe that RBI will be very cautious in issuing banking license, and the due diligence part, which remains very subjective, is an important aspect of whether one would be given banking license or not. So I mean, we'll wait for the guidelines from the RBI to to come out, and maybe some clarity on what the due diligence will entail to have a more constructive view on this. But right now, as we see, it's still early stages, and we believe that it's something that RBI will do very cautious.
All right. Thank you, Gaurav. Thank you, Harshad and Gaurav, for taking out the time for this exclusive webinar on your ongoing NFO. And before we end the this webinar, any last comment on this?
I think we largely covered what we wanted to say. Just that some people. So one of the common question was let's say some stocks have run up from the bottom. But what we are trying to say that there are two things. One is, as we have elaborated, sector is still at one standard deviation below the long-term averages. So from the valuation wise, it's still attractive. And secondly, in terms of growth, part A is the normalization of growth, which will happen in the next 12 months or so. And over the next 12 to 24 months, once the private capex come in, then I think that's the next leg of growth or compounding for the sector. So from the long-term perspective, we are quite positive, and obviously there's money to be made here in this sector.
Thank you, Harshad. Gaurav, anything from your side?
No, I think it's a sector where you can play the economy, and I think needs to be invested for a longer horizon. As Harshad mentioned, for the full cycle, a minimum investment horizon of around 3 to 5 years. So that's what we look at when we buy companies, long-term investments. So yeah.
Okay. Yeah. Thank you, Gaurav. Thank you, Harshad, once again for taking out the time for this webinar. Thank you, participants, for joining us for this exclusive webinar on the NFO. So any queries you have, you can post it. We'll definitely get in touch with you to get your queries resolved.
Thanks.
Thank you. Thanks a lot.